In 2016, the SEC lifts the 1933 ban to allow the public to invest in startups. Anyone and everyone can now invest, okay? And so to give you an example, after that happened, I projected there was probably between 1 million and 2 million people in the United States and around the world. By the way, anyone around the world can invest in these. 2 million people around the world that invested $100, okay, as little as $100 in the U.S. companies listed on U.S. crowdfunding platforms, okay? We project that number is going to drop to $10, the minimum investment amount in 2018, and we're going to be behind that happening. Next slide. Now, this is a significant event. In 2017, in the fourth quarter, Start Engine launched its Start Engine secondary market for the first time ever for shares of private companies with market caps of less than $1 billion to be liquid. As you recall, earlier I told you about the marketplace starting up with Shares Post and Second Market to provide liquidity to the shareholders of LinkedIn and Facebook, and they sold these companies, these private companies in 2016 sold $70 billion worth of shares, these big billion-dollar unicorn companies. There's 134 of them in the world, okay? So with Start Engine now said, hey, we're going to do the same thing that they did, except we're going to make the market liquid for companies under $1 billion market cap. So this, I believe, is the catalyst for startup investing to go mainstream by 2020. Why? Because investors much prefer a private market over a public to invest in emerging growth companies. Okay? Why? Because there's a lot less volatility. Let me explain this further. There's a much less volatility due to Wall Street's inability to manipulate. Okay? Now, here's what happens. Okay? So when everybody who's bought a low-price stock, I don't know if there's anybody in the world who's seen it go up before it goes down. I mean, no one's bought one just simply goes from where you buy it to it going up and multiplying in value. They always go down. They always become volatile before they go. Okay? And why is that? Because Wall Street, with their market-making opportunities, has to jigger the market and shake people out of the market. They have to create volatility so they can shake people out of the market. Okay? And people hate that. People hate to buy a stock. To give you an example, buying a speculative small price stock is different than one going out and buying a raw piece of land out in the desert or outside the outskirts of a city, and the guy buying that raw piece of land because he and his wife believe that someday an interstate's going to come through this area. So, honey, let's go buy this 100 acres out here. We'll pay $10,000 for it. We know that, hey, eventually the population's going to grow. There's going to be interstate coming through. Let's buy the land. Let's put a sign up that we're going to sell it for 5 times what we paid for it. Put a phone number on, and let's just wait for the phone to ring. Whatever it takes, let's wait. So basically, that's the same mentality that is going to work in this private market. So now a guy can go in and buy the shares, buy $1,000 worth of a startup company that the analyst says, oh, I think this thing could be worth, this dollar share could be worth $100 in 5 years. Now he can buy $1,000 at $1 a share, and he can go post it at $100 a share listed on Start Engine and wait. Okay, that's why the whole market's going to change for this, and that's exactly what's going on with the big market. What happened in 2008 when those two markets opened up to take care of the big companies. They list their shares, and the large investors come in and buy them from them. Okay. Okay. Next slide. Okay. This is the 2017. Here's the significant developments that occurred for the SICs the development was started in 2014. First of all, the freemium revenue model for the SICs was perfected. Okay. Now, what do I mean by that? Okay. Now, keep in mind that Facebook, when I discovered that the SICs were coming in 2014, I realized that I was in the position to develop the model or see the model developed for the Facebook that would eventually merge with this industry. In our video, Dynasty Wealth video in 2015, we said that this industry, the SIC industry, was going to be as big as the social media industry, and the companies that comprise this industry would have equivalent market caps to the size of the industry, the social media industry. Okay, so why is that important? Well, first of all, there's a lot of reasons, but the point is that the simple reason why it's going to be as big is because everybody's going to get into it, and Amazon can much easier sell $10 in a startup as it can a book. Okay, so if Amazon's going to get into this business eventually, that's what's going to happen. The big digital companies, Facebook's going to try to get into this business. Why? Because they can basically sell shares in a startup. They don't have to deliver any. They don't have to send a drone in to deliver it to your doorstep. I mean, it's real simple. So this is going to be a huge industry. Now, with this, I realized that the Facebook. Now, so let's talk about why this is significant. About what happened with Facebook. So so remember that the first social media company that was founded was LinkedIn in 2002, December of 2002. Facebook was founded in February of 2004. The founder of LinkedIn, okay, was a guy by the name of Reid Hoffman. Reid Hoffman and Peter Thiel, who spoke at the Republican convention, and who was the guy who made billions on Facebook, they were co-founders of PayPal. So when PayPal was sold out to eBay, Hoffman started LinkedIn, and which was the first social media company. Now LinkedIn then went on, okay, and was building its business. Hoffman heard about Facebook emerging in late 2003 and said, hey, he saw the model was going to work, and he sent Thiel in to invest the $500,000. So Thiel was the first angel investor into that financed Facebook because Hoffman knew that Facebook was onto something. Okay, so I knew when I founded Dynasty Wealth and this industry that I would be in the position to either see the Facebook that emerged. Because so let's face it, Dynasty Wealth is the LinkedIn of the model. Dynasty Wealth is a niche model. LinkedIn is only for 5% of the population. Everybody who's a businessman or selling insurance or whatever in the world is with LinkedIn. Everybody else in the world is using Facebook. So knowing that Dynasty Wealth, which focuses only on those companies that can multiply by 1,000 times and only extremely wealthy investors as its members, I figured that, hey, Dynasty Wealth was the LinkedIn. I was going to be able to see the Facebook of the industry, okay? And it's very important for everybody on this call so we understand that's the position I was in. So the next point I'd like to make is Facebook. When Facebook was founded, it didn't generate any revenue. In fact, when Facebook did its IPO, nobody really knew how it was going to generate IPO. That was 8 years after it was founded. Okay, so what happened? The significant development for the SICs happened in the fourth quarter of 2017. It's called the freemium revenue model. Under the freemium revenue model, okay, this is how it works. If you go to if Disney World were to come out and announce that they have they're going to give a free week this year. A certain week this year is going to be for free. You can ride all the rides for free. On that week, you're going to have 10 million people show up at the park. You're going to have people living and staying in hotel rooms 100 miles from Orlando waiting to get into the park. Okay? So what's going to happen when that happens is you're going to have all those 10 million people show up for the free rides, and they're going to find that, hey, there's not enough room here for 100,000 people to ride in Disney this day. So what does Disney do? They sell them a fast pass on that day. So if those of you who have not been to Disney World in a long time, Disney World now has a fast pass system that enables you to basically pay to cut to the front of the line, okay? And that's exactly what our model is. We're going to basically give, the SICs are going to give these things away to the public and let everybody invest $100, as much as they, and at the point where we have 5 times more people participating than there are number of subscriptions available, memberships to pay, then we're going to start charging, okay? And then there'll be different fees. That's the way the freemium model works. So we figured that model out, okay? So the other thing that happened is we developed the seamless investments to funding systems. The ABC, what I call ABC, was completed because if you go to Trophy Investing or you go to Apps Funder or you go to SproutUps right now, you can be a business that's looking for capital and you can automatically sign up, or you can be an investor who wants to invest in those businesses and automatically sign up. So the system is now fully automated and seamless, okay, in terms of the ABC system, okay. So what happened with that? We completed the construction of the 4 key SICs by the end of December, and we also established the Social Investing Communities Network, okay. So these are all the significant developments that happened for the SIC. So all that hard work that went in 2014 it started in 2014, culminated with these significant things occurring in the second half of 2017.